It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at Token 2049.
Hi, I'm Harry Melandri, and today I'm joined by Kimberly Flynn, who's the president of XA Investments, the registered funds division of XMS Capital Partners. Welcome to Real Vision, Kim. How's it going?
It's going well. Thank you, Harry. It's a wonderful end of summer here.
Okay, wonderful. So Kim, tell us about yourself and about your business.
So we're a Chicago-based asset manager that focuses on alternative investments. And the platform that I run has sort of two parts. One is that we have our own proprietary funds, which are alternative income-oriented funds. And we also have a business where we consult and advise alternative asset managers who historically were managing private funds and did not have any registered funds. So they weren't able to access individual investors or make their strategies available. So our consulting practice allows them to sort of learn the ins and the outs of registered funds, which includes the likes of mutual funds, ETFs, and the space where we focus, which is listed closed-end funds and interval and tender offer funds, which are terrific structures that allow this access to alternatives.
Wonderful. And can you tell us a bit more about interval funds? Like, assume I'm stupid, everyone else does, so why should you be the exception? What's an interval fund? What do you mean by closed-end funds? But just in case people don't know what those things are.
Sure. So everyone, I think, is familiar with mutual funds and ETFs and closed-end funds because there, frankly, are a wide variety of SEC-registered closed-end funds. One type that people are probably familiar with are business development companies, BDCs. Another type is a listed closed-end fund. I built many of those at my old firm, Nuveen Investments. And so a lot of those listed closed-end funds housed things like municipal bonds or preferred securities. They're known as being income or yield-oriented vehicles. This third category of registered closed-end funds is a bit of a misnomer. They're called interval funds, which speaks to the liquidity window so that shareholders, to the extent that they want to exit an investment, they do so at an interval window. Interval funds are continuously offered in the same way that a mutual fund is sold. So that's why I say it's a bit of a misnomer, because they're not really closed. They're open-ended in the sense that people can go into the funds and they grow over time. But the category of interval funds has gotten a lot of media attention in the last 2 years because leading asset managers like Apollo, KKR, Blackstone, Cliffwater, Stepstone, these are institutional alternative managers. They have launched interval funds. And the reason they're doing so is they want to access the growing part of the market, which is the retail marketplace. And so they want to serve a different clientele than they have in the past, which was largely pensions and endowments and large institutions.
Now, what's the advantage offered to retail investors, that growing part of the market? Why should they be looking or interested in these products?
Well, let me describe the types of alternative investment strategies, and I think it explains the benefit in part. So, an interval fund can house anything from private equity to venture capital to infrastructure. One of the largest categories is private credit, things like direct lending or asset-backed securities. So there's a wide array of alternative investment strategies. And typically, investors are seeking higher returns, higher yields, and the benefit of the diversification potential inside of a portfolio, which likely includes a mix of other public or more liquid assets. And so investors, this is attractive to them because these assets, oftentimes less liquid, cannot be put into a mutual fund or an ETF package. And so that's why it's really brand new access that these product structures offer.
So the key here is the lack of liquidity, the underlying asset.
That's absolutely right, which is like if you think about what you know about mutual funds and ETFs, highly liquid securities designed that way so that investors can get in and out of the fund easily. An interval fund, some of them allow access going in on a daily basis, but the interval speaks to the out, which is that to the extent that you do want to sell your shares and get out of the fund, you are going to be limited to an interval of, let's say, once per quarter. And to the extent that other investors want out of the fund, there may be a queue of other investors ahead of you. And so shares upon redemption are subject to proration. So you may only get partial liquidity. And think about why that makes sense if you're a private equity investor or an infrastructure investor, given the long time horizon for the investment or deployment of that capital.
It does. The first thought that comes to me is this concept of the conservation of liquidity. Like you can't create liquidity where it doesn't exist. So yeah, what you're trying to do is repackage it in a way to concentrate it on certain dates. So there's an exit on a certain date. It's concentrated on that, and then the asset manager knows how much liquidity he's meant to draw up, and he has the opportunity to go and look for, I don't know, banking, possible, lines of credit or other investors to come in and use that entry and date as their entry while you're exiting and something. But it seems to me like I recall investing in CEFs, closed-end funds back in the 90s.
Right.
And naturally the lack of liquidity on the underlying asset pool meant that when everyone wanted to sell to get out, you got a big discount to net asset value develop.
Yes.
Which is what Ration does for getting out. You like double took on the 20% discount, double took again on the 40% discount, which I took the 20% discount.
Yes. So listed closed-end funds, as you mentioned, they can trade at premiums and they can go to discounts. And it's largely about supply and demand. And so moments like March of 2020, where there wasn't much demand, you did see listed closed-end funds. You also saw ETFs deal with massive redemptions. And you saw, because listed closed-end funds don't have to stand ready to redeem, what happens is the price goes to a discount. So people get liquidity, albeit at a discount. They may not be happy about it, but at least they have the liquidity that they need. Now, interval funds, because they are non-listed closed-end funds, the liquidity, the benefit is it's a trade-off here because the liquidity is at net asset value, not some publicly traded price on the market, the way a listed closed-end fund is priced. An interval fund, it is in and out at net asset value, but the out, you have this gate, effectively, this sort of limited amount of liquidity. And I think you expressed it in a very thoughtful way. Asset managers need to think long before they launch the fund, and frankly, well before an event in the market like a 2008, where you had liquidity dry up for a long period of time, because you have to have means by which to navigate those volatile periods in the market. And so, for example, what some private equity funds will do is they'll have a companion asset class, like public securities, maybe private credit, something that's more liquid, so that they can provide the liquidity that's been stated. Now, I think you're also kind of speaking to expectations, and the reality is that a lot of investors, their preferences for highly liquid portfolios. And so there definitely has to be some tolerance, if you will, for a small portion of your portfolio. To the extent you are interested in alternatives, you know, the time horizon for that investment is probably going to be different than how you think about the more liquid side of your portfolio for these very reasons.
Right. So I think I've forgotten who it was, maybe Harley Bassman. Somebody said like no bad bonds, only bad prices.
Yeah.
And I think the same's true for asset classes, right? No bad asset classes, only excessively large allocations to them.
Yes. Yes. Well, people actually fail to realize how illiquid bond markets, municipal bond markets, you know, even treasury markets can be, right? And so bonds are sort of, you know, just one example is that there can be episodic illiquidity. So in those
Hell yeah.
moments, right, when the market demands liquidity and buyers step away, there's not a lot you can do. And so it is about having your asset allocation model and your plan. And frankly, this is, I think, what good wealth managers do is they counsel you through, frankly, what you are willing or able to tolerate. And some investors, frankly, for behavioral reasons, are probably best sitting in 100% liquid assets, but you are giving up potential return if you have that kind of portfolio.
So let's talk about that potential return, because if there wasn't some advantage to the alternative space, this whole conversation makes no sense. You have to be able to see an advantage. So where are these advantages? What is it that people are missing out on in the public markets that they can get in the alternative markets?
Well, let's stick with the private equity example because I think there's so many Americans that are interested in that, you know, getting access to private companies, partly because U.S. companies are staying private longer, but the historical return going back, you know, let's say over a 20-year rolling period for private equity is about 14% on average. And that compares to the S&P 500, which over time, the anticipated returns from a S&P 500 portfolio maybe in the 8 to 10% range. So you're picking up incremental return versus public equities to the extent you invest in private equity. Now, bear in mind a 14% return, that's the market, right? And one of the things I think in preparation, Harry, that we talked about with alternatives is manager selection is even more important in the private markets. And so there's a wide range of possible returns, and the higher returns are going to be achieved by managers with long track records managing institutional pools of capital. And so, frankly, I think a lot of their managers are always happy to share their impressive track records, but there is a wide range, and that can be if unfortunately you've picked a manager that doesn't, you know, performs on the other end of the spectrum. So you have to be very careful with manager selection, and that contrasts with the public markets where there's a really tight clustering of performance, frankly, around the benchmark. You don't see that in the private markets, but nonetheless, it's compelling. People are looking for return pickup in private credit. They're looking for yield pickup. There's a lot of retirees, income-oriented investors that want more from their income portfolio. And frankly, just think about the last 2 years. You've real estate is an area where a lot of investors have allocated, partly because I think there's a comfort with some of those tangible assets, and real estate provides typically some level of income and then additional return on top of that. So a lot of those real estate investors have shifted into other parts of the private markets, including infrastructure and private credit, because they're looking, obviously, people have been concerned about commercial real estate recently, post COVID. And so they're looking for other types of alternative income. And that's why we've seen really a large growth in the category of interval funds on offer.
So this sounds a little bit like putting all those two components together. It sounds like people have a comfort with physical assets or a preference for physical assets, which is what you're tapping into in this
Yes.
space.
In my long career, I've never built or marketed or been involved with a real estate fund. So I'm not a real estate expert, but it has always surprised me when I speak with financial advisors and individual investors how many people use tangible investments. Maybe it's a portfolio of rental properties. Maybe it's farmland that was inherited or passed down. And I think that people, when you can look and see evidence, in the way of a senior housing facility or a farmland here in the state of Illinois, it's easy to get your arms around what it is, what's inside the portfolio. That's a little bit harder when you're talking about things like private credit, like asset-backed lending or direct lending. It's kind of a step removed, and so that's why I do think that tangible assets are so appealing, because I think every American who owns a home or rents a home, you understand kind of the economics of real estate from that perspective. So I do think there is that understanding there.
I think people think they understand. Um, and it's been a source of all of my greatest errors. Overconfidence has allowed me to lose ungodly amounts of money in really stupid ways in the past. What I would say, though, is that there's a Groucho Marx comment which always comes to mind in these moments, which is, I wouldn't want to be a member of any club that would have me. And that seems particularly true for things like private equity. I mean, I'd love to be in Bono's private equity pool. He's done very well, but I think we get invited to different private equity pools, and my private equity experience was not Bono's private equity experience. I guarantee it.
I think you've got a very important point, particularly for private equity, maybe even more so for venture capital, because a lot of those opportunity sets are capacity constrained. And so, you want to be asked, are you getting the good stuff? And, if these firms, if it's not the same strategy as the institutional strategy, you have to question, do you want it? Right.
Yeah.
And so that's why I do think we were talking about that index return for private equity being at 14%, but there is such a wide range, and access and capacity constraints are a big part of it. And I actually think, to your point, that is why areas of the market like private credit and infrastructure, where there's less dry powder, if you will, although frankly, infrastructure has been raising so much capital the last year. A lot of the firms like KKR and Apollo, who have raised big infrastructure pools, they're in the process of deploying that, and they're buying things like wind farms and airports and toll roads, so big physical assets. So I think you do want to question any new opportunity with respect to how much capacity, and it comes up a lot in the REIT and the BDC market, because a lot of those products are evergreen in nature, and they can get quite large. And I do think you should question, so I think people think that there's safety in numbers or there's comfort in a larger fund, but you do wonder if some of these big, massive funds are pushing up against those capacity constraints. And if and when they do, eventually you're going to see it in your returns.
So one part of me, one of the things that occurred to me as I was thinking about this, doing various chores and giving kids breakfast, stuff like that, was this question of what the fee structure is. Because it's never mind the quality. Tell me about the fees.
Sure.
What is the fee structure? How is this going to look to a retail investor who pays attention? I'm that cheap that I ask about fees. Terrible.
Well, it's smart to do so. There was just a recent Wall Street Journal article. Jason Zweig covered the interval fund space, and he was particularly critical about fees because they are significantly higher than mutual funds and ETFs. And as we know, mutual fund and ETF space fees have been coming down significantly. So this is sort of a contra trend in the marketplace. What I'll say is that I'm going to quote the average, but the average fee doesn't tell the whole story. So the average interval fund management fee is 119. Okay, so that's already above, 100 basis points. Um, but I would say the most frequent observation for management fees that we see in the market is about 150. And if you're talking about private equity, if we continue with that example, there are particularly some of the sophisticated managers with a lot of skill. I'll give an example, like a Hamilton Lane, for example. They are charging 2 and 20 in this registered product structure, just as they do in their private funds for institutional investors. So, in one way, it addresses your concern or objection. Is the manager giving me the same strategy? Yes, they are, and the
He better
fee
be at those
and
fees, right?
and the fee is the same. So I think that there are plenty of market participants and innovation trying to bring down fees, and we're seeing it across a variety of different alternative strategies. Um, Private equity and venture capital, I do expect the fees to remain fairly high, just as we were talking about, and maybe that's okay, as long as people understand that. Some of these incentive fees can be complex because you pay based on performance, so the fee is lagged. So it doesn't show up necessarily on the fact sheet or in the expense table. You do have to read the prospectus to understand, um, you know, what full freight you're gonna be paying.
You want to unfuck your shit? This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Yeah, so what popped into my head was that everybody out there can see the value of having semi-permanent capital or longer persistent capital, maybe the best phrase. The longer the duration of the capital, the more you can lock up high, I guess it's not alpha, it's beta, high beta assets, and leverage those beta assets to take your fees out of it. So for the asset manager, it makes a lot of sense. But what does the retail investor get back? In some cases, like I can see the retailer is getting access to a product he wouldn't otherwise get, and the asset class is so attractive, you need to do it. But that's the issue, isn't it? It's who's getting what in this game?
Yes. And so if you think about all of the participants in the market, motivations vary. And right now, I would actually say that most investors either are not aware that these opportunities exist, or they may be introduced to some of these products by their financial advisor. And so many of them probably don't, maybe if you look at the average asset allocation today, it's about 2%, 2 to 3% to alternatives. So I think some people might argue that they're doing just fine without alternatives. The question is, if you think about it, going backwards in time, in the 80s and 90s, even just up until a couple years ago, the U.S. public equity markets had such robust, sustained growth over a long period of time.
Yeah.
And I think academics have long argued, oh, you need international equity, you need European debt, you need these different types of diversifiers. And I think that some of that advice has been ignored, and U.S. investors end up with very U.S. equity dominant portfolios. And so that means that typically the average investor has too much exposure to U.S. public equity. And we were reminded of that in 2022 when neither bonds nor stocks performed. So I think that was an opportunity for advisors to have the conversation with the end client, because frankly, the end client has been largely satisfied with the historical performance of public equities. So the question is, going forward, will the U.S. economy and the public equity market be the place for growth? And I think a lot of folks argue that with private companies staying longer, that U.S. investors are missing out on a lot of the growth. SpaceX is an example. There's a lot of other unicorn type companies, but there are real regulatory and market driven reasons that these companies will continue to stay private. So we want to be able to access that growth, and private market opportunities allow us to do it two different ways. We talked about private equity. There's also one of the biggest categories of growth is direct lending. And so as banks have stepped away from providing loans, not just to us, consumers, banks have stopped providing loans to corporations. And so there are private investors, large private investors, who've stepped in to fill this direct lending gap. And so direct lending, the liquidity is also not there. You can't put direct lending assets into a mutual fund. They can be wrapped up in a BDC or an interval fund. And so that's another way. If you're probably more income oriented as opposed to total return oriented, direct lending might be appealing because you're participating in sort of the economics of middle market US companies. And that's another way to kind of tap into the growth of the private markets.
So I mentioned the Groucho Marx saying, and I do try and live my life by that. I would not want to be a member of any club that would actually have me. There's obviously a paradox in there, right? But you make a fine point. Like, why do we have access to Tesla, but we don't have access to SpaceX? And being the kind of perverse-minded person that I am, I can't help but think that SpaceX has got to be the better trade. Because I don't have access to SpaceX. He doesn't want to sell me equity in that thing. He does want to sell me equity to Tesla. I want the one I can't get. So that's one thought that occurs to me. Now, in the case of the BDCs and the banking assets, I know why that opportunity exists, which is we have bank capital adequacy rules and bank regulation. And these, over the last 40 years, this kind of lending has not been considered particularly profitable by banks. So they've allowed other, they often originate the loans. In many cases they don't, but they have in the past originated loans and they sell them off the balance sheet. Now BDCs originate themselves, I think.
They do.
But it does make me wonder, because back when I was young, banks were massively pro-cyclical assets. Like when things were great, they made a lot of money, and when things were terrible, they suffered a lot of defaults. If I own the BDC, am I going to suffer defaults when things are bad?
Yeah, absolutely. Anytime you're investing in middle market credit, or to that extent below investment grade credit, there is going to be some level of default, and then eventually potentially loss. And so that's why the case that these direct lending firms make is that active management is really important to mitigate loss in the event of default. And we've been in a period of time where defaults have been very low since 2009. And so I think that there is some anxiety, I think, in the market regarding kind of where we are in the cycle today, so that we may see higher defaults. And the reality is defaults will happen, particularly with below investment grade credit. And the question is, sometimes losses can be mitigated based on, to the extent that the company goes into default sooner rather than later. The worry, I think, right now is a lot of these companies are sort of limping their way into default, and so losses could be higher because there's sort of less of what's valuable left at the point of default. So absolutely, as a credit investor, you've got to be very mindful of that. I do think that the sophistication of these direct lenders, the tools, the teams, the talent left those banks and went to these private firms. And so you still have the same sort of very talented credit investment professionals analyzing these companies, but it doesn't change the underlying potential for default or loss.
I can't really work out what I think of this. Like, one part of me thinks if there's a big enough cycle, the BDCs will be in trouble. Certainly the ones investing in levered loans. That seems to be a potentially problematic space. If anything, junk bonds are no longer as junky as levered loans. So if you want the lowest, if you want the junkiest of the junk, levered loans is where you look, not junk bonds. But the other part of me, I do some real estate investing myself. Um, uh, and these days I get pitched on lending by brokers who are representing private equity firms and direct lenders.
That's right.
And their terms are very aggressive. They frankly, the odds are that when I refi anything I refi, I'm going to end up refining one of these guys. Um, and that then makes me think there's probably an adverse selection problem for the banks. Like, if these guys are coming in with fresh capital, are they not going to pick up all the best quality business because they can outcompete the banks, and the banks are just going to be left with the drossy stuff? Am I wrong to think that?
Well, yeah, I've long I don't it's a good question. I've long wondered the same. And I think that the banks have largely opted out entirely of certain types of loans that they used to be in
Mm.
the business of making. So in your example, I don't even know if they're left making any loans because as we know, I mean, banks are very conservative, highly regulated. And so I think that what happens though is that there are some companies it's probably more of a small, on the lower end of the scale that they do struggle um, to get the loans that they used to, and so that's why I think you're also seeing, um, venture financing and venture debt financing. So you kind of wonder about the part of it. Obviously, it's for a high flying venture backed company. They would never be able to get a bank loan, but they have alternatives. So you do wonder if there are gaps in terms of companies who used to be able to get loans that now can't. Um,
Mm.
one area of growth that we've seen is real estate lending, and I know you mentioned you're a real estate investor, and I think a lot of that is people. A lot of investors have walked away from real estate private equity, concerns about valuation. And so it is, for whatever reason, there is more comfort around real estate debt or real estate lending than buying the equity with the concerns about valuation. So we have sort of seen a shift or migration to the debt side of things. But it is a good question, and I am probably not the best person to address like how are those gaps getting addressed, and maybe people are just having to seek alternative forms of financing if the banks just aren't there to lend.
So, um, turning to, like, how should retail users? So you said right at the beginning that this was really about asset allocation and having access to asset classes in a 401k for a retail investment product that you might not otherwise have. So the RIA might say, look, you've got this much money, 2 million bucks or something in your 401k. Why don't you have some kind of allocation to forestry or some kind of
Mm.
allocation to private credit? Because these public pension funds have it, and it's a diversifier. You don't have enough diversification. And in the last 40 years, US equities have outperformed, like Nasdaq has outperformed global equities by a factor of 3 or 4. S&P something not that far away from it. How long do you really think that will continue? Uh, the thing that bothers me about that is the last 20 years. You could argue the last 20 years was the Swenson models. Like, it was a beautiful time for the Swenson model. So David Swenson was the head of the Yale endowment, and he was a big proponent of alternatives, and he hit the ball absolutely out of the park. As a result, every endowment in the US to some degree has some forestry, they have some hedge funds, they have some private credit. Is this late in the game? Am I joining that golf club just when everybody else is joining the other golf club?
Um, it's a good point, but the part of the reason that these private fund sponsors are now targeting the wealth management channel is that those institutional capital pools are shrinking. So the burden for saving for retirement, now that I don't have a pension, is on my shoulders. And so it's really more about shifting pools of capital. So it used to be that a pension fund would invest in a similar ways, like an endowment like Yale, and they too had fairly long duration type asset portfolios. And so part of the reason that why would Blackstone or Apollo even care about the retail investor? It's because defined benefit programs are shrinking rapidly, and so that pool of assets is in decline. Whereas because there's so much wealth accumulation among U.S. retail, this is happening also in Europe, but not at the same pace or rate. And so in the U.S., the growth is expected to be anywhere from 13 to 17% compounded annual growth. And so there are smart business reasons behind the shift. And so I think don't think of it as being late to the party. Think of it as sort of, because now we're, as retirees and saving for retirement, we now need the same wealth creation tools that the pension funds had. But we need them packaged in a way that's more
Right.
accessible, because a private fund is a pain. I don't want K1s. I don't want my taxes to have to file for, a delay and
Extension after extension
extension.
after extension. I'm still waiting for a K1, by the way. I've
I
got one still
know.
to come.
So the one thing I'll say is that interval funds have been referred to by wealth managers and RAs as like the easy button, because it's
Yeah.
easy for their clients, it's easy for their practice, and it's easy to get. You're not talking about taking somebody from a 0% allocation to private equity or private credit, to a massive allocation. You're talking about taking them from 0 to 5, or maybe from 5 to 7. And so we like to think about alternatives as substitutes. You've got your income substitutes, and you've got your total return substitutes. And things like infrastructure, farmland, timberland that you mentioned, those are real assets that I like, because they've got both some income property and a little bit of additional total return. So I like those for a lot of income oriented investors. You have private credit, but frankly, that is where all the capital raising has been done. So I think you do have to be cautious right now, particularly around direct lending and some of those things where there's just been a ton of money raised.
And a cov light environment. So
Yes.
I'm coming across stories of investors who bought cov light paper, discovering that just means that they can be used and abused by the underlying borrower.
Yes. And the cov light environment can lead to higher losses in the event of default. Like it is a reality. And so none of us know what the next 12 months holds. And that is definitely, that has been feeding into some of the concerns that we're seeing in the equity market even. So I agree with you. And that's why, like, there are things like timberland, the example you mentioned, it's not correlated to anything in the public markets, the fixed income markets or the equity markets. And there's things like catastrophe bonds that's linked to weather risk.
Yeah.
There are real
By the way, there were Bloomberg stories about cat bonds saying
Yes.
that the best performing hedge fund in the world made that money out of cat bonds.
Yes. And that, just like anything else, there's a huge spectrum of risk involved. There are low risk ways of investing in that catastrophe insurance linked securities market. And then there's high risk. And I've seen that too. Some of the best performing interval funds last year, there was a fund north of a 40% return, and it was investing in some of the riskier insurance linked securities. So, but I like things that are truly uncorrelated. We're talking things that are credit or equity, even if it's private markets, are still going to have a fairly moderate to high level of correlation.
So spill the beans. What do you like? So you mentioned forestry. What else?
I like farmland. Everything I like is in a diversified actively managed approach. Like I'm not encouraging people to go buy a single parcel of land, but there are really
Yes.
terrific diversified approaches. I like infrastructure that's really been growing in popularity. It has some inflation protection benefits.
Sure.
There are parts of private credit that I think are still really, really interesting. There's just like the mutual fund space. There's so many different sub strategies and subcategories that I like within the credit markets. I
No,
think
but
that
you're a pro, and you've seen loads of this over the years. You've initiated, you've started up a whole bunch of these funds for other people. So when you say what you like, I'm paying very close attention.
yeah, I mean, asset class specific. We've kind of talked about the things that I'm particular because those are areas that people in the past, there are a couple real asset products where they actually put all of this together. They put the timber and the farmland and some of the infrastructure assets. I like that because I like that for the average investor. Because the reality is you need to put an allocation to work that's meaningful, that you're going to watch it, follow it, add to it. And
Mhm.
so sometimes, um, you know, so I do get excited about some of these new innovative ways to access the market. I will say, not necessarily my recommendation. The enthusiasm is definitely in the market for ways to get access to venture capital. My phone's ringing off the hook. People are trying to get access to unicorn type companies. And so that actually I think is a positive sign. A year or two ago, I think there was enough concern about valuation of those companies, not wanting to do down rounds. But I think that i- you know there's definitely a lot of interest in venture capital.
That's really interesting, because I know that if you gave me a chance to get out of the PE, which is kind of venture capital type things, I would take it in a heartbeat. Right, I would absolutely take it in a heartbeat. But when I was thinking about like how I would construct the best possible case for this, it seemed to me that what I should do is I should have an idea of what I'm interested in, and then just have those tickers up in the space and watch them all the time. Because if you see, if we get a market event, a lot of stuff will trade at discounted to net asset value. And that's how often do you get to buy things on sale? So if I see, have forestry ETFs, for example, trading at a 20% discount to NAV, that's when this seems like a really compelling proposition to me.
Yeah,
Um,
it can. I guess it can de-risk your entry point, right? I
mhm,
mean,
yeah.
in the interval fund space, there actually are secondary market buyer platforms. One's actually called Lotus, LODAS, and that's what. So there's been a lot of headlines about, for example, B REIT, which is Blackstone's non-listed REIT, and other like Starwood REIT and KKR's REIT. Um, Once again, concerns about valuation, but some of those funds shares have been trading away from the fund at discounts, sometimes large discounts. So I think that if you are a more opportunistic buyer, there are ways to express that view now, even in things that don't trade on the exchange.
Yeah, I look at things like commercial real estate, and I think to myself that market hasn't cleared yet.
Right.
And so the most likely clearing price for pools of those assets are in closed-end funds of it, where people are looking for buyers. And if you wanted to buy it, I would definitely look at that kind of space. Me personally, I don't want to buy that, but if you did want to buy it, those kind of closed-end funds, those closed-end funds in this space are probably a better way of trading at the right price now. Um, it seems to me. Um, but perhaps I'm missing the big bit. I don't know.
No, I think you're right because I mean I think a lot of investors, and that's why you're just also speaking to um, the, you know the ETF markets, particularly now with mutual fund managers launching active ETFs. I think that there is such a preference for that tradability, and we're seeing that, right? It's hard. It is harder with less liquid assets. There are a few examples of, and like the public BDCs We do find a lot of yield investors like to trade those, but public REITs, another example, but the public nature of them adds an element of volatility on top of the underlying asset volatility. But the advantage is, you can get in and out.
You can take your loss.
That's right.
There's an advantage to being able to take your loss as well.
That's fair.
So if there was going to be a message to potential investors, what would you like to say? Because I think we're running out of time. So what would the message be to people looking at this and who are curious and want to dabble?
Well, I would just say that, there are so many more opportunity sets, and, now there's really attractive fund sponsors who have largely served institutions now managing funds that are accessible in a way that 3 years ago they're just were not. These are the market leaders in alternatives, and so interval funds. It is the only structure that you can have less liquid or illiquid private assets. So it's worth exploring. That we have resources on our website if you want to learn more just about the structure. But the nice thing is that there are these are 1940 Act SEC registered products. You do have the protections of a fund board, looking out for shareholders. You do have a 1099, and those are the attributes that make it easier for investors to start and think about what sort of income substitutes they might want, what sort of total return substitutes, as they look to diversify what may be a largely, U.S. large cap dominated type portfolio. And so I think it's sometimes we've talked a lot about risk and volatility, which is appropriate, but I think sometimes people overlook the risk in a U.S. large cap or a FANG stock dominated portfolio. And so you're talking about vol in the high teens. For a portfolio like that. Most of these alternative strategies, particularly the income-oriented ones, have much lower levels of volatility and risk. So look hard at what you're currently invested in. Have sort of a eyes wide open approach to understanding the volatility that you're being exposed to, and think about some of these income substitutes or total return substitutes. And bear in mind that it may only be appropriate for a small part of the portfolio. And that really is about not just risk tolerance, but your investment horizon and risk appetite.
Again, that's great advice. One silly observation to make, which is I've not liked US equities. And for some reason, it's now the single biggest part of my portfolio. That didn't happen because I chose it. That happened because it outperformed. So it's just a simple function of the outperformance of the asset class that you might end up with an awful lot of big cap US stocks, either implicitly or explicitly. So a lot of people maybe will find themselves in a place where they should start thinking about why their portfolio is so heavy in those kind of assets, and should rethink it and have an intentional asset allocation rather than an accidental one like me.
Yes.
I'm grateful still.
And maybe do it more frequently than on an annual basis, because as you point out, it can get skewed very quickly. But I think some of these opportunities to access some of these private companies and private strategies is exciting. So frankly, it's a conversation that you want to have, and it's research that might be interesting, more so than evaluating kind of the next mutual fund or ETF. So I would encourage people to explore alternatives.
Fantastic. Thank you so much for joining us to discuss this.
Thanks, Harry.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at Token 2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.